Welcome to the Financial Quarterback with your host, Jim Lineweaver.
I'm Jim Lineweaver, your financial quarterback since 1993. Are you frustrated with your bank's savings interest rates? Here to talk to us about a few options to get your money working harder for you is Travis Dragan. He's one of our portfolio managers. So Travis, where should we get started?
Well, over the last 6 decades, the S&P 500 index has produced average annual returns of roughly 10% per year. However, in a period of down markets with elevated volatility and rising interest rates, it may make sense to accept a slightly lower return with reduced risk rather than potentially producing no return or even a negative return. And right now, CDs and short-term bonds offer rates in the range of 4.5% to 5.5% return.
Yeah, brokered CDs are at the lower end of that range. Right now, they're at about 4.5% to 4.75%. And the Fed is continuing to raise rates, so there's a good chance that these rates are going to continue to rise, and there's a way to take advantage of this.
Right, there is a way to take advantage of it, but it's important to remember that CDs are typically fixed-rate investments, meaning that changes in interest rates won't affect CDs you currently hold. So what we typically do is structure these CDs in staggered maturities in what we'd call a CD ladder. What that allows is as these front-month CDs roll off, we can then reinvest at higher prevailing interest rates, allowing investors to take advantage of the trend in rising rates.
And keep in mind, different interest rates will be applied to the different durations of the CDs. They can also have the advantage of being FDIC insured up to $250,000.
Right, and that brings us to our other available income strategy, which is short-term bonds. So unlike CDs, which carry FDIC insurance, bonds don't carry FDIC insurance, but they do offer a higher interest rate to compensate for that risk. So right now, short-term bonds offer rates in the range of 5 to 5.5% return.
And there's a lot of different types of bonds too. There could be corporate bonds, municipal bonds, or even United States Treasuries.
Right, and some characteristics that should be taken into consideration in bond investment strategies is term of maturity, credit quality, and even the tax status. It's important to remember that the rates offered at different maturities can differ, and differ materially sometimes, along with the values.
And one of the advantages of municipal bonds is the tax status. Currently, they are paying close to corporate bonds and can be triple tax-free, meaning that they are exempt from federal, state, and local taxes if you buy the right ones. And when you factor in taxes, that usually means a higher rate of return than the corporate bonds.
That's right, and within fixed income, there are many different investment strategies, including the approach we previously discussed, which was a CD ladder and a bond ladder structured in a similar manner. Now, as previously mentioned, bonds don't carry FDIC insurance and therefore have slightly higher risk than CDs.
With the combination of the market volatility and rising interest rates, many investors are seeking other options. So if you have cash you'd like to get working more efficiently for you but don't like the risk of the stock market, give us a call. You can also log on to lineweaver.net to get this flyer listing what we talked about today. And remember, we're always here to help. Stay tuned for Fox News Sunday.